Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike. And today it is my pleasure and a privilege to welcome Mikhail Pritsker. I'm just going to call him Misha. That's how he goes as. Hi, Misha. Welcome to the podcast. It's great to have you. And Misha originally is from Moscow, but he lived in Israel for many years. And now he lives in Miami area. And he's an investor with us, and he joined Tempo team as Director of Asset Management and Underwriting in early part of 2023. He holds an MBA from Chicago Booth School, and he also has CCIM. But before we jump into the business, tell us a little bit about your family. You have a lovely wife, a couple of kids. Just tell us a little bit about that.
Sure, Mike. Thank you so much for inviting me today. It's a great pleasure and honor working with you. So I am 43 years old, and I have three kids. I have a daughter. She's 21. I have a son. He's 4 years old, and I have a daughter. She's 2 years old. Actually, my son is almost 5 and daughter almost 3, but still, they're formally 4 and 2 yet. We lived in Israel for a while. Yes, Mike, you're right. Originally, we're from Moscow, Jewish family that moved around the world, and now we settled here in Miami area in Boca Raton. So here in Boca, we have a kind of joke when the Jews were looking for a promised land, and they ended up in Boca. So, yeah. So please welcome.
Thank you.
I got my MBA designation from University of Chicago Booth School of Business in 2020, right at the time when COVID hit the planet. And then I got my CCIM designation somewhere in 2021, I think. And I'm proud to be the part of that community that provides us with a lot of valuable knowledge and resources. And I'm happy to work with Tempo family for almost a year as of now. And ready to talk about everything we need to talk today, Mike.
Yeah, thank you, Misha. I appreciate that. And we're recording this episode during the very challenging time in Israel with a brutal attack from Hamas. So our thoughts and prayers with all the people of Israel. We stand with Israel now and always.
Yeah.
Now let's talk a little bit about real estate and the changing world of real estate investments with what has transpired over the last year and a half, with interest rates having risen so much. So let's talk a little bit about the challenges of existing investments, portfolios. What's the best practices in portfolio management? And then we can jump into new deals underwriting. How do we get into great new opportunities? What has changed from the underwriting perspective? So let's cover these two topics. So let's start with the best practices today in the portfolio and asset management. You work with multiple folks on our team and external folks to lead that area. So what has changed? What's the biggest challenge now in the area of portfolio and asset management?
You know what? We had like a very blessed time, before COVID hit the planet. When the 2008 crisis passed a little bit, and 2014 everything started to catch up. The multifamily, storage, retail offices were all behaving pretty well, and sponsors used to have a huge margin of errors. Yeah, they could afford changing the contractors in the middle of renovation process, or changing the broker, or leasing agent, or property management. Everything took a lot of time, but since the markets were growing and growing and growing, the market was forgiving us for everything pretty much. And that caused some bad habits in between sponsors, and sometimes I can see that also in between the underwriting teams that in charge with the underwriting process and dealing with sponsors. So everything started to be looking like very easy, I would say. Now the times are getting hard. Now you see that the margins of errors are very, very tiny, if the sponsors are not behaving within the property management, or you see that the contractors are not delivering the renovation pace in time, or you see that the estimation of your occupancy is not there, or it's too aggressive, or if you see that the rental increase because of the renovation in multifamily business, is too high. If anything of that is not working, you're screwed. Nothing is going to work out for you, especially if you multiply it to the abnormal interest rates that we have right now in the market. And a lot of people were hoping to get the refinance, and they use the previous metrics to get the whole amount of refinance. But now when they're going to the bank and show them the NOI and multiply it and all those mistakes and mismanagement, and they just cannot borrow as much as they need. And that means that, especially when the rates are so high, meaning that they just have to go on the capital calls for under defaults. And that's what actually bothers us super much. So starting that time, we significantly increased, speaking about the best practices, we shifted from quarterly reviews with our sponsors to basically monthly or sometimes even weekly, bi-weekly reports. So we track on what's going on in our projects, very hands-on. We have boots on the ground right now. We visit our projects pretty much like every other month to see what's going on. Because the practice showed that yet we build our relationship with our sponsors based on a full trust and commitment. It's not about them being, wrong. It's just about the environment that changed, and we're not getting used to it like this. And they're not getting used to it like this. So we need to help them in a way, because the financial side of that is the most sensitive side, we put a lot of risk in there. We put our investors' money in those projects. So we got to be hands-on. So we go there, we talk to the leasing agents, we talk to people on the streets who are the clients of those buildings. We do way deeper demographic analysis right now, trying to estimate the demand side. We look at the lead funnel, how are they performing on a monthly basis. We pay a lot of attention to Google and other application reviews that people can rely on when they choose the property where they can live. Again, I'm speaking general about the multifamily stuff right now, since it's the main part of our portfolio. Yeah, so that's probably it. So we have hands-on. We do the reporting more often right now, like bi-weekly, monthly, and of course quarterly as well. We started to create more transparent system for our investors, so our investors could be aware of what's going on. Would it be good news? Would it be like, medium rare news or well done news, or good or poor news? Yeah, so we want them to be aware of that. So we do the town halls. We talk to people in a more transparent way than ever before, and we try to keep our words. That's probably the big picture, Mike.
Yeah, Misha, I appreciate that overview. Everything you said makes sense. It's just to summarize, it's focused on operation, making sure that the execution is strong. And the big difference, some folks have executed really well in the past, and they continue to execute well now. And some folks, as you said, were executing at the old way of doing things, going to the property once every 3 months, every six months, and the properties were just kind of chugging along and everything was fine. And now it's gotten a whole lot harder on the operating side. And then on the financial side, things gotten way harder because the interest rates have shot up. And so let's dissect this a little bit more. So what happens when the value add projects, when they borrow with floating rate interest, which has been the norm? It's not something that folks have been stupid and just took the variable rate interest rates or floating rate loans just because they had nothing better to do. This was kind of the lay of the land. This was the norm. Fixed rate debt was available for stabilized property projects, and most of the value adds have been variable. So how much pressure is this putting on these projects, and what can we do about it? What are the solutions?
Well, I want to emphasize one thing before I jump into that actually the good sponsors who are really taking well care of their projects, normally we see that as a very well vertically integrated systems that they have. And I'm going to build on that, answering your questions. What I mean by that is that the sponsors are having a lot of control right now in operations. That's why they succeed in this environment. The people who succeed have a lot of vertical control. They have contractors in their structure. They have property management in the structure, leasing agents. They have like maybe some procurement divisions that bought a lot of materials for their add value projects in advance. That's why they manage their costs. They manage their operations fairly tight. And what happens when the floating rate? I mean, you just put on the top of the software the rates that we have right now, and that service that they want it to be is going to be way higher, meaning that, especially considering that the NOI is not as high as it expected to be, they cannot borrow as much as they wanted, and they cannot refinance. So the system is kind of pushing them from both ends. From one hand, their real performance metrics are not there. From the other hand, they cannot borrow as much as they wanted, and the rate is just simply going high and high and high, and they don't have enough of their operation NOI to cover the debt. So they either have to go through some capital calls and achieve more, attract more financing, or they have to somehow restructure the debt splitting in a way. So people are looking for refinancing here and there. They're going for some shark money loans, but it doesn't help them that much because the revenue side is struggling. So it's like a scissors in a football. So you can't do much in here. Yeah. So people are going to renegotiate with the bank. We see that, for example, like in our Little Rock project, what I'm talking about. Yeah, when there is a problem, the only thing you do is you knock bank's door and you try to negotiate somehow with them. Hey guys, give them a little more time, please, because you don't want to do the foreclosure. It's going to be a pain in the butt for you. You need to take care about the asset. So the banks are not super favorable in this case. So we don't see that much of these type of defaults right now. But I think, and I sincerely believe that during 2024, we're going to see way more vulnerable projects in the market that could be used as an advantage to some people. But in general, the market is suffering right now.
Yeah, thanks for those thoughts. I think what you're referring to is kind of known as the maturities cliff. That's one of the terms used. There are other terms where the rate cap expirations hits those projects that borrowed in 22 on a 2-year rate cap. And the interest rates provide a lot of pressure. Simply inability to refinance or making it much more difficult to refinance. And recently we've seen not only short-term rates having gone up, but also long-term rates. And the refi is really connected to the long-term rates. Although this more and more evidence that the Fed is likely done raising interest rates at this point on the short, on the Fed funds rate, that controls the short end of the yield curve. But on the long end of the yield curve, the 10-year Treasury is what controls mortgage rates, and it has gone up in fairly significantly in the near past. So that's creating even more pressure on the refinancings, as there's not enough debt service coverage to be able to borrow at any LTV that is meaningful. It's the biggest issue. People borrowed at 75% LTV on these bridge loans, and now they need to refinance, and the bank's only giving them 50, 55, 60%. It's gotten a whole lot tougher. So what do you think is the solution? And I don't know there is an easy solution. It's almost like we have to persevere until rates cycle back down. This is kind of the general thought process, and I've spoken with a number of experts in the industry, that you got to keep fighting the operating battles, do the best you can on the operating front, and then do capital calls or whatever has to be done to survive, have these projects survive until the interest rates cycle back down. And the interest rates, at one point on the interest rates that I wanted to mention, and let me know your thoughts. Some folks are concerned that the interest rates can climb further. I think we're at the peak at this point of time, although I don't have a crystal ball. My guess is good as anybody. Short-term rates are definitely at the peak. If Fed does another quarter or not is less relevant. We are either completely at the peak, or if it's another quarter, that's not a gigantic material impact. And then on the long-term rates, the thought process here is that there's certainly certain forces that's forcing the rates on the long-term bond having gone up. But in general, these much high interest rates are not here to stay, at least in not my view. Now, we're not going back to reserve policy, zero interest rate policy, but once the inflation comes back down to 2 to 3%, long-term interest rates need to come down as well. So that's kind of the thought process. So what do you think? I'm just curious your thoughts on the subject.
Well, first of all, in that expectation of kind of recession in people's mind, everybody talking about the recession, 2024 is still going to hit us and so on. The interest rates are serving as a very bad service, of course, and that puts a lot of pressure. But what gives me a little hope? We're not in an environment where emotionally or psychologically we feel the reaction to recession. Because if the real stuff starts to happen, the interest rate would have been now 5 or 4 or 3, everything just going to start falling. And thanks God we're not there yet. I mean, I'm glad that people are holding the characters, the banks and everybody with their judgments that it's not going to happen. And that's what I think we should really be careful with in our expectations. Because a lot of people talk, they speculate about it. They know what's going to be. Nobody knows what's going to be at the end of the day. We just have to be very careful looking at what's going to be in the future. So let me start with question number 1. What can we do to mitigate it, to mitigate the situation? Well, first of all, we are investors. We're not the managers of those syndications or multifamily projects or a valley project, whatever. As an investor, I think for us, it's important to be sober. And sometimes it's better not to invest and wait a little bit versus investing into something that is dangerous. So we are conservative here in a way because we're responsible enough with people's money. So we better wait a little bit and look for strong opportunities that might pop up in this market, and they will definitely come, versus just doing nothing. We can just stay a little bit out of that. We can wait a little bit. Yeah, we can wait 6 months. We can wait 8 months. We can look what's going on and take care of existing projects. From our egoistic perspective, I would say, we got to be just careful and not to take any opportunistic stuff on board just because we think, hey, it's a good time, let's grab everything that is, laying down. We got to be still careful because they're laying down for a reason. The second thing about the interest rates and what's going to be, the overall picture about the interest rate, about jobs, about the net export, and about the overall structure of the GDP, I'm not sure that it helped that much overall to the inflation because of course, it slowed down the consumption market, but still we see a lot of governmental spending. Since we still see a lot of export problems. So kind of if you look at this GDP equation, just solving it with purely raising the interest rate up doesn't help fast and doesn't help much, because we all know that the overall horizon that the interest rates are affecting is like about 5 years. So we're going to see a lot of happening during the next 5 years that starts now because people are still taking money, and we're going to see what's going on. But there is a political kind of component to that, the component of our external relationship with our suppliers in different countries like China to manage the export part of this equation. We got to be very careful with our governmental spendings, because that kind of inflows the market with money and with a lot of possibilities that basically pump the inflation up and put the upward pressure on these numbers. So I believe that if the Fed would just continue raising it, that would be kind of the curve of that effect will go like that. So you can raise it as much as you want, but without changing all other components, it wouldn't affect you, that much. That's why I think psychologically going to stop around where they are right now. Maybe like a little pause, maybe one more increase, just a tiny one. But what's going to happen afterwards, I am not sure, because I don't see that much of effect. Let me give you a simple example. Meat in Costco. If you go and purchase a pure beef, I pulled up my bill for, I think, last October. A piece of beef that I normally buy to cook some borscht was $32. Suddenly, months ago, it happened to be $50. And everything is going like that. My average purchase basket in Costco was about $250 like per batch, I would say. Now it's about $400 per batch. And the basket is remaining the same. So did it help us, the raise of interest rates. Well, to a certain extent, it might stop what was going on, but it definitely doesn't help us with inflation to the extent it should, I think.
Yeah, I appreciate you sharing that example of the meat. Maybe that particular item has seen a huge inflation, and many other items have seen a lot of inflationary pressure, but some prices have come down. So I don't want to spend a lot of time, but I remember paying $8 for a dozen of eggs, and now they're back down to a much more reasonable level. So some items have experienced very high volatility and not come back, like beef, and some other items could have cycled back, like eggs. But the interest rates do fight inflation in general, and the problem is Fed has only one lever to pull. They don't have
exactly
control mechanisms. They do what they can, and it takes a long time for these high interest rates to propagate through the economy, and they impact different parts of the economy differently. So let's talk a little bit about new deals. So like you mentioned, we're very, it's very quiet right now. We're sitting in 2023 doing very, very few deals. It's a lot slower than 22. And I just came from a conference where one of the speakers is a national originator for commercial loans, does a lot of multifamily loans and other commercial deals. And he acknowledged that the volume is down 60 to 70% from last year. It's a very significant drop in the transaction volume. The refinancings are down to only critical refinancings where you have to refinance. Nobody was going to refinance to try to take the money out. It's an impossible situation. The rates are way, way higher now than a couple of years ago. So refinancing business is gone. On the new purchase money loan, the leverage is low, and the credit underwriting is just significantly tighter. So in this environment, the only way you want to transact to buy, if you get a superb deal, you have to get a great deal, otherwise it doesn't make sense. And then the sellers on the other side, if you don't have to sell at a steep discount, why would you sell? That's why it's kind of like bid and ask widely spread. So what are your thoughts? When are we going to start seeing some more transactions happening? Are sellers going to start capitulating from the pressure of the high interest rates where they can't service the debt? They got to sell, or they're going to lose the property to a bank. And then some banks are cooperating, and some banks are playing the game called extend and pretend. So we're going to see a lot of problems probably in the economy in the upcoming, 12 plus months with these high interest rates. Again, as I mentioned, maturities cliff, variable rate, cap rate expirations. So what do you think? Is it going to force a lot of sellers to start capitulating because they can't deal with the debt problem? What do you think? And you can do a really good job operatingly, but if you got debt that's squeezing you too hard, you can't fix the operating issues fast enough. The interest rates have gone up so much that pressure is way faster than you can raise rents, right?
You're right, absolutely right. I think we're going to see a lot of opportunities next year because basically there is nothing you can do if you don't have enough NOI and your debt service is increasing and maturity cliff is there. You cannot refinance. We should see some opportunities here and there. But on the other hand, I believe that if people sitting, I just got back from a conference from the left field investors in Columbus, Ohio. Yeah, out of 100 people, there were like maybe 80 investors. People are sitting on the money and they don't know where to deploy that because they don't see enough juice in those deals. But as long as those deals are going to hit the market, there got to be some competition who's going to take the sweet part of it. That's going to, put some upward pressure on those prices. So there's still going to be some competition. Of course, it's going to be a little lower than it would be on the more healthy market, but still, I don't think it's going to be very, very bottom because a lot of people are sitting on the money and they want to grab those things. And the advantage would belong to the structures who have the better connections with existing sponsors, who had a chance of building long-term relationships, and who can basically take it before the deal hits the market. That's the first kind of point. The second point is I've seen, not many, but I've seen a couple examples where the sponsors were smart enough and they raised money with some equity reserves. So they raised like $2 million more than they needed. And they convinced investors, they convinced their co-GPs that it's that's the strategy they want to utilize. And now I see these people surviving. that actually helps them to sell the property even in an existing environment, having this the cash cushion, I would say, because they basically market it the way that, hey, no worries, you're going to have enough money to serve the debt, even if this, the floating rate is going to, keep you this level for the next year. So you're good, and people are buying it. On the other hand, I mean, let's think about it a little differently. If the project is pretty strong, it's strong enough, and it generates the nice cash flow, and there is a value for there is space for add value. Let's assume that you're happy with buying it with a high interest rate. You're going to get zero, or maybe you're going to get even negative cash distributions for the first year or two. But if you believe that the project is good enough, with a good allocation, with strong market, with a strong manager in place, and you believe that the cap rates are going to compress back within 2-3 years, especially after elections are going to take place, the presidential one, I mean, normally everything is kind of settled afterwards. Some buyers are thinking about it this way: let me buy it now with a negative cash, and I have enough equity reserves. But in the future, since the cap rates are going to significantly compress, I will recover and I will have a big capital gain on the project, because the project is there. It's not like a poor C class somewhere where you struggle every day with your tenants. The other sample that I saw is, I have a good friend in California. They run a big multifamily fund. They have like about 110,000 doors under management. And I reached him out and said, how do you behave these days? He says, we're all in cash. We don't borrow money at all. We have enough money. We have enough cash. So we just buy everything using the equity. Yeah, we know that we deliver for this period of time a little low returns for those equity holders because we don't have the leverage. But the equity holders are happy with that, since the projects we're buying they're kind of strong first. Second, we bargain a good price. And the third, we're going to refinance them when the market is going to be healthy. Since we're buying it for the horizon of 5-6 years, we're going to be better off doing it this way right now. So it all depends on the way you look at it.
Yeah, I appreciate that perspective. And that's exactly the way to buy. You either buy with low leverage or you buy with low leverage if you can, right? Not everyone can buy without leverage. You sitting on that much cash is actually
exactly
that's awesome. And those people who have bought with large cash reserves, that was great, hindsight. And then folks that are sitting on cash and can borrow with low leverage can buy deep. I mean, the term for this is
exactly.
buy deep. You have to get a great discount. If you don't get a great discount, why buy today? There's absolutely no reason. And most of these investments, multi-year time horizon. And there's a good old rule: buy properties when the interest rates are high, and then refinance and sell them when the interest rates are low. That's a general theory that has worked for a long time. The assumption here is the high interest rates will force
go down.
Prices down, yes, and then you can buy deep. That's the whole idea. So we're on the same page. Misha, I appreciate you coming on the podcast. Thank you for sharing your wisdom and your experience. And
thank you.
Yeah, if folks wanted to reach out, is there a good way to reach out, say hello? They can certainly do it through us, through Tempo. But what's the best way to get a hold of you? If whatever you feel comfortable sharing.
Just shoot me an email. It's going to be mdpritsker@tempofunding.com. M like Mary, D like Dora, Pritsker, Pritsker @tempofunding.com. So more than welcome. Please reach out. I'm happy to talk. And we also are issuing a little series of videos about the underwriting process. So welcome to watch them too.
Thank you kindly for sharing. Appreciate you coming on the podcast.
Thank you, Mike. Thank you. Have a good day.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.